Dan, you've done some work on what history tells us as far as this shift post-recession when investors try and dabble in value-type companies. What do we see? What does history tell us to expect?
Well, what you really begin to see is that people start to nibble at the bait a little bit. They're beginning to see now that the growth types of names are very, very extended with regards to.
Dan, you've done some work on what history tells us as far as this shift post-recession when investors try and dabble in value-type companies. What do we see? What does history tell us to expect?
Well, what you really begin to see is that people start to nibble at the bait a little bit. They're beginning to see now that the growth types of names are very, very extended with regards to overall valuations, even though they're playing the momentum trade, and I don't doubt that that'll continue to some degree. They begin to take some money off the table. They begin to rotate more into value. If nothing else, the professionals certainly begin to hedge their bet. They tend to move a little more into the growth at a reasonable price first. They tend to go into deeper value. I think you're going to see some acceleration in that versus in a normal cycle, just because the interest rates are so low. So we're clearly seeing a lot of demand in the high dividend area, which frankly is an area of very attractive valuations now, mainly because it became very, very beat up because people were concerned about dividend cuts. And the reality is, with the exception of a few notables, mainly in the energy space, there really hasn't been any significant dividend cuts. As a matter of fact, dividends are actually still going to be net slight increase for the year. So I think people are seeing that the reentry trade may not be, and reopening may not be quite as dynamic as they were hoping. But you're not going to completely fall off a cliff in earnings, which means you're not going to have huge dividend cuts. And we're seeing a very distinct migration back to that with regards to purchasing power. And I can tell you clearly we are seeing it with regards to client interest, with regards to capital flows.
I want to talk about some of the companies that you like right now as ways to express that view. But one other point here on the historical side, you've got a chart that looks at growth and value performance after recessions. We know we just went through like the fastest one ever, but it still, I think, should count, right? The weird thing about this, Dan, is we had such a powerful bullish move in the growth companies. When I look at this chart that goes back to 1970, yes, it's value that does better eventually, but growth also does well. Do you think we get that this time around, or did we already get the growth performance? I mean, does the huge valuation move in the NASDAQ limit the degree of upside in growth going forward?
Well, I think it is going to be limited, and I think that what you've just basically already taken that to the bank. I mean, these stocks, if you look at the FANG stocks and add on really the two other majors, I mean, they're not only priced to perfection. I mean, they are really priced at stratospheric type of levels. That when you look at any reasonable growth estimates for them and begin to look at a PEG ratio, it really is just something by any reasonable analytical quantitative valuation is really not sustainable. And so I think the best that investors can hope there is that even though these are great companies, they're going to have dominant market share, they're clearly going to continue to grow, but they're just unlikely to grow at 33, 34%, which is what they would have to do to maintain these levels. So again, I think you take a little bit off the table there. You don't have to go out, because I'm not going to ignore that the momentum trade is there and it may not go away anytime soon, but get yourself down to a more normalized position from a portfolio management standpoint. I mean, the value you saw in the beginning of this week and then last week, I mean, you literally saw the most dramatic turnaround and growth in value in the last 50 years. You literally saw, when you looked at the growth indexes, they were down about 1.8% in a particular day, and the value was up 4. I mean, there was almost a 600 basis points closure. And indeed, you've closed from a 40% gap down to about a 33% gap. And so even though the reversal may ebb and flow, you really saw that the traction, at least out of the gate, was literally at levels we hadn't seen for half a century. And even though we might get false starts and retrenchment, I think that trend is going to continue especially being led by professional investors like us that are going to clearly look for value and cash flow.
One company that you like within the energy space, Phillips 66. I mean, a lot of these right now, Dan, they look like still some of the worst charts out there, even after the rally the last couple of weeks. I mean, you look at kind of like the list, you go the category of value and reopening, and then even within that, there's this kind of stratification that we've seen over the last month on which stocks respond the most. What do you think about the way Phillips has responded here? I mean, we were at the March lows coming into the earnings right before Pfizer's story hit. What needs to happen to really kind of turn energy companies around? Because it's almost like the market's kind of telling us, look, there's other better places to play a vaccine.
Well, I think that you saw a big turn on the Pfizer news and the vaccine and the reopening trade that you begin to see energy consumption, and in particular gasoline consumption, which is over 70% of the market, that would rally and go back to normal levels. I think what the market is missing is that at the height of COVID and the height of the shutdown, we were in a position where gasoline consumption was down 40%. Right now, from pre-COVID levels, gasoline consumption is only down 10%. Yet you look at Phillips 66, it's trading down 45% from where it was pre-COVID levels. So it really is discounted it to really worse than the worst levels. And the current price right now is just in anticipating that we're going to go back to a complete and total shutdown that really is even a little worse than it was before. And we really just don't see that. So when you look at a Phillips, you got to bear in mind that 66% of Phillips is actually refining. The other 34% is also upstream, and it's in storage and transportation. And it's trading at a 12 PE. They got nice, solid cash flow. They're actually the only energy company that's going to make a profit this year. And you get 5.9%, almost 6% while you wait. And for a taxable investor, that 6% is getting taxed at 20%. And so as it turns around, even if it takes a little time to realize the value in the stock, look, you're getting a yield at 6% that most people, if they feel I could lock that in for 2021 for an issue in my portfolio, that's not a bad return by itself. So if nothing else, it's a good place to hide out, if you will, while we see the reopening of the economy.
One of the other companies that you like, Omnicom, a advertising and corporate communications company. This has been a sector also that's been under pressure, but a yield there too of over 4%. So it seems like the idea here is you really want to find those high yield companies. Do you think that the risk of yield cuts or dividend cuts is past? If these companies didn't slash or to get rid of it over the last 6 months, then they're good to go into the future?
Yeah, I think they are, and I think Omnicom is actually a prime example of that. I mean, this is a company that actually has negative capex. I mean, they're in a situation to where they have extremely strong cash flow. They have extremely strong pricing power. They're literally, as you mentioned, they're yielding almost 4.5%. They're trading at an 11 PE. And as soon as you have any reopening, and we're seeing it already, that you've fully discounted and started to turn some of the advertising cycle. And as soon as you begin to see doors open and people return to a little more normal consumption and mobility levels, then you're going to see a rapid increase in advertising, because people want to get consumers back into their shops, back into the seats of restaurants, and you clearly are going to see a very good turn. And even if that gets protracted a little bit, I mean, they're in a very strong cash flow position. They're extremely well managed. They have a lot of ongoing leverage capability. And once again, you get 4.5% while you wait. So I think this is one that, on a reopening basis, it'll bounce off of the bottom actually, very, very attractively.
Want to make sure we mention the last one here, Altria, that you like within the staples space, as one could describe it. The whole group has been struggling, and they keep cutting down the jewel valuation, Dan. I mean, a very different story here that seems to be very company specific, the case for Altria. How do they turn this around?
Well, if you look at their overall growth in sales and growth in pricing, they're very, very consistent that every single year you see generally 3% price increases, and you see anywhere 3 to 5% increases in overall revenue. And the stock is right now trading at a 9 PE level. It really is trading, if you will, at a price that it was at the top of the mania that the entire tobacco industry was going to be legislated out of existence. And clearly that didn't happen. And the fact is it's not going to happen. And when you look at Altria, people have to bear in mind roughly 15% of their total sales right now is beer and wine. They're also a major player in vaping. They're going to be a major player in cannabis. And they're also going to be a player in any kind of non-combustible tobacco. So they're very smart management. They're diversifying their product mix. And like some of the other names we mentioned, I mean, not only are they in a position trading at a great value with frankly solid earnings despite the press clippings, but there you get 8.5% while you wait. I mean, so you're approaching a double-digit return and a very solid dividend that they keep increasing. And again, right now for part of my portfolio, I can lock up 8.5% going into 2021 in a very uncertain time period. To me, that's a good bet.